Peter Rose, Longwood Currency Trading. Good morning. It's a hot late June 2021 day. It's supposed to get hotter and more humid. We may catch a break later on in the afternoon to get some rain, but I don't know. So the first 5 pips are the hardest. Yeah, what's that all about? Well, if you've done any trading at all, and you're relatively new to it, then these experiences are fresh in your mind. If you're a more advanced trader, think back. When you traded before in the start, and even now sometimes, you take that position and you just want it to move in your direction. You know, you're the VIG down to start. The spread's against you to start. So if you've got a 2 pip VIG that you're paying, you're 2 pips out when you put the trade on. If you don't understand that, by the way, you need to look at some of the mechanics and the plumbing of the currency market and trading process. But anyway, you're 2 out to start. But you'd like to see the price move in your favor. I mean, that's just the price of doing business. That's your ante that you're going to put into the pot to play the game. But how do you get that? How do you get that price to move? How do you get that initial momentum going? You know, the tendency when you begin trading is you'll have 6 or 8 losses to your few wins. And then hopefully you're going to get more experienced and have more wins than losses, but you can still end up losing money because when you hit the stop, you're taking whatever stop out value that you have. And then if you have a fear of letting your price run, you're getting out short sheeted. You're getting out at 10 pips or whatever it is, and it's tough to make up. It's tough to make up the losses, and you don't want to trade jump ball. So you look at that chart, you put that trade on, and you're just going, go. And, you know, why do I say 5 pips? Well, I'm a day trader. Okay, and 5 pips is a lot of fucking money. You can make a living at 5 pips. Better if you make 10, but look, 0.5% all per 1,000 is, you know, if it's $5 on 1,000, $50 on a full lot, $500 on a 10 lot. I mean, you know, you could make it on 5 pips. So that 5 pips is important. You got to get over that first 5 pips. So when you're trading, if you're working to identify your trade entry points and you're exhausting that energy and you're taking the effort to make the trade, then when you get more experience, you're probably going to want to go in with 2 lots or 2 minis. And when you get to that 5 pips, scrape one off and bring your stop to break even and hope for the best. Now, that doesn't do much for your percent on risk gain if your second lot drops off, because now you've made 0.025% on your risk, because you're risking 2 lots to make 5 pips. And so you could look at that very negatively. But you still made the 5 pips, and you protected that. It's very difficult. Trade entry is very, very difficult. But if you can get over that 5 pips, it indicates that your entry was well-timed. Not that it was a good entry point, but that it was well-timed, such that the momentum of price has carried it up at least that first 5 pips. You know, in day trading, we're only looking for 20 pip profit targets or 30 pip profit targets, averaging out maybe at 20 that you're shooting for, and you're lucky to get those. Probably not. I'm not getting the 20. If I average out over 600 or 800 trades, I'm not making the 20, even though my profit target might be on that trade 20 20 pips. I don't take a trade unless the offer is at least 20, 30 pips. That means the potential is there for price to move. Now, that doesn't mean that it might have some kind of a retracement, but Jesus, you got to have the price have enough juice in it to get past that first 5 pips before it has a retracement. If your timing is off, price may go, you know, to your profit target, or you might get 10 or 15 pips out of the trade. But you know, if you have that retracement right away and you're running short stop, as I am, an 8 pip stop on a 5 pip ATR, if that thing turns around and hits my 8 pip stop because of a retracement, that doesn't mean I was wrong. It means rather that I had the wrong timing. So I've been talking about momentum. That's what we're looking for in that your trade entry. It's not good enough that you pick a good potential trade. You have to pick the when of it. In my training to students and throughout the video that I've done for YouTube here and on my blog post, there are 3 components of making a trade. You got to know what to do, you got to know how to do it, and you got to know when to do it. Learning what to do and how to do, that's the simple shit, but that's what everybody focuses on instead of the when. When do you go in and take that trade? You could have all the clearance in the world, you could have everything all set up, and if you pick the wrong time, as I've said, that thing could just flip around and do a retracement. Maybe it goes over the 5 pips, but if it flips around and goes back, you have to be able to judge that position, price action position, as to whether there's a likelihood that price will have enough to go that first 5 pips right away. And that's why my price stop, my trade stop is at 8 pips, because if it doesn't go that way, I made the wrong timing. I might made the right trade as far as all the gobbledygook that constitutes a good trade. But if it turns around and it doesn't do what I thought it was going to do, I got to get out. I've lost more money by ignoring that. And then when you go into loss, you say, oh, it'll come back. Well, I'll let it go a little bit further. Let it go a little bit further until you get to the point that I don't give a shit about it anymore. I'm not going to think, blah, and then you go walk away. You can't do that. There's money on the table. You can't do that. So how do you judge that? Well, that's a class, a course in itself, and I try to go into that in great detail, even for the beginner course that I'm working on writing. But suffice it to say, don't feel bad when it just seems that your price isn't going where you want it to go. It isn't you. It's nothing that has to do with you or the price or scalper institutions are hacking you or stop hunting on you. It isn't that at all. And you can have this problem, and it becomes even more severe when you're a long-term trader, because if you're shooting for 200 pips, you don't have an 8 pip stop, for Christ's sakes. You got to have a 100 pip stop if you're shooting for 2. First of all, I don't want to lose 100 pips, just on the off chance that I'm wrong. But that's up to you if you want to be a long-term trader. But regardless of that, if you're looking for 200 pips, you're not going to be getting out with with a 5 pip gain or a 10 pip gain. You got to stay in the game, man. You got to run that through, and you got to suffer those retracements. So how do you know whether that's a minor retracement, it's a major retracement, or maybe you're at a swing point? How do you know? Well, you got to be really, really good about the long-term bias opinion that you have of that trade. As a day trader, I don't have to worry about that. I can look at price action and I can make the judgment as to whether it's feasible for me to take the trade or not. Because I only trade one currency pair, I only have that one decision to make for the day. I look at the thing, yeah, it's okay, I'll stay with it, and then in a couple hours I want to be done. if it doesn't look like it has the momentum at that particular time to take the trade, I'm not going to force it. I'm not going to do what I call anticipatory trading. I'm out. I'm not going to take the trade. I'm not even going to go in. I'm not going to put the order. I'm not going to put a limit on. I'm not going to do it because it doesn't have the characteristics of price action that look like they will enable that price to move at least 10 pips before it starts to have a pullback. It's so aggravating to try to make these, and that's why the scalpers can get banged up pretty badly if they're waiting for that 10 pips. If you're a scalper, you can't wait for the 10 pips. You take 3 pips when they give it to you. And then if it's still going, you go in again and you take another 2 or 3 pips. And then it gets going again and you go back in. And if it turns around and it takes 4 of the 6 pips that you took, you get out because it might have turned around. So you've got 3 or 4 trades and you've made 2 or 3 pips. Well, you know, that's just the way that the scalpers work. You have to have a certain mindset to be a scalper. You have to have a kind of a different mindset to be a day trader. You have to have a little bit different mindset to be a swing trader. And certainly if you're going to be a long-term trader, you're trading off the daily charts or the weeklies or something like that. But I don't think as retail traders that you know, you want to try to trade like a bank and warehouse this stuff and go through all this stuff, because the risks that you have to take, particularly in the beginning when you really don't know what you're doing. You're taking 100, 200 pip risks to make 500 pips, but if you don't have the skill to get the 500 at some point, and it might take weeks to get 500 pip, the price to move 500 pips. So if you don't have the skill, you're going to take those 100 and 200 pip losses, boom, boom, boom. You know, if you're trading a full lot, right now, pound dollar is going to take almost a $7,000 margin on the trade. That leaves you, if you have $10,000 account, it leaves you $3,000 of wiggle room to play. So if you're taking a 100 pip loss, that's $1,000. You get to do that 3 times and you're screwed. You're out. You're to the wood. You got to reload. I don't see it. I don't see it. If you can do it, that's great. I mean, I'm not saying there are folks out there that can't do it, but you got to be really, really patient, and you have to be really, really good. As a day trader or as a scalper, I don't have to be that good. I'm just picking the low-hanging fruit and going home at the end of the day with a small handful, because that's all I need to eat. And I take a little bit of that handful and I put it aside and make the account grow. You don't make a lot of money from a small account. So you learn on a small account, and then when you're convinced that you know what you're doing and that you've overcome that oh shit, price flipped around on me right away. Once you figured out how to overcome that, then you can load up with a $50,000 account. You make, you know, geez, you make 1% on that, it's $500 a day. 0.5%, $250 a day on a $50,000 account. You do that 3 times a week. You're making pretty good money. You're making almost replacement income for our lower tier level jobs, clerks in stores and low level cash register managers or stuff like that. You're almost replacing that income. And if you can't replace, well, who cares? It's 30% of that income or 40% of that income. If it's 15% of your income, your job isn't going to give you that. So this stuff is really worth doing it. But you've got to get good enough to get over that first 5 pips. It's a funny story. I was a real estate investor. I retired as a real estate investor, and I remember the guys that I hung around with were always saying, and they were all much more successful than I was, because why would I hang around with losers? I hang around with people that are better than I am, so I could learn. And they always said, hey, the first million's the toughest, and after that, boom, it just goes like shit through a goose. And that's really true. And when I got up to the point where I had a couple of $1 million of real estate and I could see the cash flow coming in, and I was making money from my job, and I was making money off the real estate, and I had a lot of money in cash and stuff, I said, well, I could buy another building. I could do, well, now you're just like on an autopilot and this stuff just boom, 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 and it just piles up. But again, there's timing there because you could run into one of these friggin' collapses in the real estate market that we had back in, I don't know what it was, 2013 or 14 or something like that. I had a $250,000 condo. It was worth $250,000, and it lost $100,000 in value in the crash. I mean, we're 40% gone, history. I just didn't have to sell at that time, so it was okay. I sold a couple of years later. I got a couple of $100,000 for it. So it obviously didn't get to $250,000, but you know, at that point I was retiring, and I came up to buy this house, and I paid cash for that. Fortunately, I didn't have to sell that condo in order to buy this house, or I'd have been like everybody else, scrambling around trying to sell that so that I could lock in the purchase price. You don't want to be in that kind of position. You always got to have dry powder. But in order to get that dry powder, you got to make that first 5 pips. You got to buy that first building. You got to renovate and sell that first car that you fixed up. You got to paint that first painting and sell it. Those are the tough things to do. So if you're having problems with that first 5 pips, everybody's got that problem. But what it means is that you don't understand entry theory. Doesn't mean it isn't going to happen for you. It means that your knowledge is lacking. So go find somebody that knows what they're doing and pay them whatever they want to be paid, because in the long run, if you can just clip that 5 pips, you'll more than make up the thousands of dollars that you might have to pay a mentor to counsel you. And if you find some dumbass that's going to sell you a course for $49.95 or consult with you for $50 an hour or some cheap shit like that, that's exactly what you're going to get. You get what you pay for. The first 5 pips is the toughest. Learn how to fix that, and you got the whale by the tail. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And I'm going to go inside because it's getting hot out here, even in the shade.